Now, if you are going to trade live, remember that trading is risky. Please don't trade with funds you can't afford to lose, and talk to your broker. Make sure you understand that there are risks involved with trading, any type of trading, stocks, futures, Forex, options. Now, in looking at what I consider price action, really what I want to do is I want to look at what the candles are doing at any point in time, okay? And when you see this candle or this candle or this candle, you have to ask yourself, what is it exactly that the market is showing me? So remember that the market is coming from a location, from a distance, or from someplace, from a price, from something, and it's moving either down or it's moving either up, okay? So in thinking about price action, what I like to do is I like to see first that the market is actually going in a direction, or either up or going down, to then figure out, should I be a buyer or should I be a seller? So we have to look at first, where is it coming from? Well, right now the market's coming from this high right over here, and it's on its way down like so. So if you're going to be a buyer, you have to think about, why am I buying the market? And you have to think about buying the market only on methods that are counter trend. And counter trend methods here, counter trend, are based off of, as the market goes down and down and down and down, you want to do the opposite. You want to counter that trend and buy it, right? So looking at what type of methods exist that are counter trend or going against the trend, you have to ask yourself, why am I doing what I'm doing? And so we have a couple of methods that are counter trend. The X5 is counter trend, the roadmap is counter trend, the blueprint is counter trend. Counter trend methods are basically going against the overall current move or the trend. Now you have to be careful with counter trends. And one of the ways, I'm going to teach you something here about stops. One of the ways that you could protect yourself with not getting really hurt with a big stop loss under a counter trend type of trade, like the X5 or the roadmap, anything like that, is looking at a type of pivot. And if the market is going down and you're thinking, well, I'm going to buy it, and I'm only going to buy it when it starts to reverse and go in a counter trend direction, use this low as a pivot in order that if it fails, if the actual trade that you're working on is not going to go in your favor the opposite way and it goes down instead, use this as a pivot. And the same thing, let's say that you are thinking about selling it and the market's going up and up and up and up and it starts to turn around and go down, use this here, this highest high, as a pivot. So you have to have first a reason to be a buyer or to be a seller, and whether you're doing a trend or counter trend, we're just discussing here counter trend here for the moment. The way that I like to use my stops is not just a catastrophic stop and not just a time-based stop, which are important, but I also like to have pivotal stops, because if it breaks this pivot for whatever reason, let's say you're believing the market's going to go up, you're countering this little move to the downside, use this as a stop. I call that a pivotal stop. Now, in addition, one of the things that I think benefits a pivotal stop is not having your stop exactly on the lowest low of that candle or exactly the highest high. I like to give it a buffer. 2 ticks below would be my pivotal stop. So I like to teach 2 ticks, a little bit of a distance here, a little bit of a buffer, and I'll tell you why. Markets love to test where they've been. And so it's very common to see the market test highs. You've heard of double tops or double bottoms. So when you're thinking about having some type of a pivotal stop, whatever the case may be, don't use the exact low or the exact high. Give it a little bit of a buffer. For example, 2 ticks would be my pivotal stop in case it comes down to test that, and maybe you don't want to get stopped out prematurely. Maybe it goes a tick through it, but then it doesn't stop you out. So pivotal stops, I think, are one way to keep you out of trouble. And also think about distance. Another situation they may encounter is, what is this idea of overbought and oversold? Now, you've heard these terms, but what do they really mean? The market's overbought, oversold. I'm going to give you an example on the way that I look at what is considered overbought and oversold. When it comes to, hey Mustafa, being in a trade and taking a trade, what really makes a trade overbought, oversold, so you can avoid it, right? A little bit of a filtering mechanism here. So let me show you what I mean. I'm going to come here into the future. As we see here, the signals begin to populate. So let's say that you're going to buy the market here, and you're waiting for this buy, whatever market, whatever situation you happen to be in, you're going to be a buyer here. But instead of you buying, let's say it's a counter trend move, and instead of you buying here, the market comes and touches this price and automatically does this. Okay? So you obviously, as a counter trend trader, you're thinking, well, as the market comes down, I'm going to buy it, but I need a little bit of proof. I'm going to wait until the market reverses. And when it does reverse, it reverses so hard and so strong that puts you all the way up here. And so you wait till the candle closes, and now you're going to buy the market here. Now consider what just happened. The market's coming down. You're deciding, well, I'm expecting the market to reverse, and I'm going to be a buyer, but I have to wait until it turns around. And instead, when it does turn around and gives you the opportunity to be a buyer, it happens here. If you consider the pivotal stop, which we just spoke about here just a moment ago, a pivotal stop which is here, and you're considering where you're entering is here, that distance where you're entering, because you see an opportunity to be a buyer, and your pivotal stop is here, this distance makes the trade overbought. And it's a problem, right? So if you think about this in this fashion, you don't want to enter into a trade, whatever it may be, buying or selling, after it's made a large move, because that is what I consider a riskier proposition, overbought, oversold. Instead, consider that you want to be a buyer, and instead the market turns around, and it does this. And then maybe there's another candle that does that. Now, you consider, where am I being a buyer? I'm being a buyer right here, and my pivotal stop is here. That distance between here and here is much smaller. This is what you want. You want to enter at the beginning of a move up or down, especially when it comes to counter trend trading. And so if you ever encounter a situation where you have an opportunity to be a buyer or a seller, but yet in comparison to the pivotal stop, or in comparison to where the market started its move up or down, or in comparison to where you're entering, it happens to be not at the beginning of this trend up or move up or reversal. It happens to be a very large distance in a short amount of time. That's not a good idea. That's not where you should want to trade, because from this point forward, if you really think about it, if you bought here thinking it's going to go higher, it has to continue to go higher, and it has to make a much larger move for you to be successful, to make some profit out of this trade. At this point, it may be over. The trade that you wanted to take is closer to here and not after it's made a big move. So just a couple of things here to consider. I'm going to see if I can find an example to show you here of what I'm referring to. I know sometimes when I teach, I have to show you the examples drawing it out, but I also want to show you a situation maybe like this here. This is overnight, obviously, but you can see that the market started to come down and it gave a short signal, right? So in the beginning of the move, and at the start of this move up or up or down, if you're able to go short at the beginning of this move as it starts to go down, great, right? You're at the beginning of the move to go down short. But if you place a short trade here, and the signal happened here, and you weren't able to get it, or it never came back to the signal, or for whatever reason you just you weren't able to get it, or it happened too fast, this is not where you want to be. If the price is here at the beginning of the move down, there's no reason to go short here, because from this moment forward, it still has to go lower for you to be successful, and it may not do that. You're at a disadvantage. So I want you to consider the beginning of a move up or trend down, or the beginning of a counter move or counter trend up or down is where you want to be. And let me see if I can show you another example of that. This is just scrolling through the charts. I'll take a look at yesterday and see if I can show you some examples as well. Let's take a look. So take this example here. This happened at about 12 o'clock, and this is a losing trade, by the way. So I'm going to show you the good and the bad, right? Not every signal is going to be a winning trade. And a great example of using stops or pivotal stops, and you're thinking about going long, right? And you have this entry here at 41.55.75, and you look back and you say, you know, if this signal doesn't make it doesn't hit my stop, and it doesn't go in my favor, and if you have a stop already set in place, where should I have a type of pivotal stop or a way to get out of the market if it doesn't go in my favor, right? So as the market starts to go up and it fails to continue, look back to see if you can identify a pivot or a pivotal stop of some sort that'll help you get out of the trade, even if it's a short or small stop. So even if you say, well, here is where the market kind of stopped and paused and continued higher, using a pivotal stop, just a tick or two. I like 2 ticks. So 2 ticks from the pivot, whether it's here, whether it's here, whether it's here. Keeping that in mind, you'll be able to get out of the trade sooner. You don't always have to have a hard stop or catastrophic stop. The 3 stops that I like to use are as follows. They are a time-based stop, so something based on time. The longer you hold on to a trade, the worse off you are. I also like to use hard stop, or, well, I consider it a catastrophic stop, where it's a catastrophe, it all goes wrong, get out of the trade, it's some type of catastrophe, a hard stop. And then you also have a pivotal stop for the Atlas line trades, or for counter trend trading, or if, for example, I'll switch here to the Atlas line here in a moment, where I can show you a pivotal stop, where the market is going up and up and up and up, and then you have some type of pullback and it starts to continue up and up and up, and I'm using that here as my pivot. And let me just actually, instead of just talking about it, let me just show you. Let me just go to my charts here. If you're new to day trading and want to learn more on the benefits of trading the markets, visit DayTradeToWin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.